is run by a bunch of investment bankers, and Morningstar's modus operandi.
Hello, I'm Fernando, Luque, editor for Morningstar in Spain, and I'm joined today by Marcus Pakenham. Marcus is a product specialist at HSBC Asset Management. Marcus, thank you for being here.
Thank you for inviting me today.
Okay, thank you. Marcus, we will discuss the bond markets in general. What is your view for the bond markets in general?
We think that the bond markets will continue to be volatile. And I would separate it into two parts. If you look at the government bond markets, it's likely that government bond yields will rise from here. They've been very low because of the QE programs and because of weak economic growth. Mm-hmm. Global economic growth is really coming through quite nicely in most areas. And with the US starting to think about reducing its QE program, it's likely that US yields are going to rise from here, and that'll lift up other bond yields in Europe and elsewhere. On the credit side, we think that the corporate sector is actually in very good health, and so while the credit spreads, which is the difference between the corporate bond yields and the government bond yields, has risen recently with the market volatility, we think that's not really justified, and we think it's likely to come back a little bit. So we think there's better value within the credit markets.
Okay, let's say that this is your most probable scenario, but what would be the worst case scenario for the bond markets?
Well, in terms of the government bond markets, clearly, over time, government rates or the yields on government bonds will rise from their current level. That is likely as they move to more normal levels. And at the moment, we expect that to happen quite gently. But if we had very strong economic growth out of the US, unemployment came down much faster than we expected, Chinese growth started to resume a little bit, and the monetary conditions stabilised there, then there's no reason why government yields couldn't move up much faster. And that would probably upset all bond markets. Mm-hmm.
And what would be, the most attractive segments in the bond markets?
Well, again, if you contrast the government with the corporate side, we know that many governments are struggling with the level of their spending, government deficits, the amount of debt that they have outstanding. So, and because we expect government yields to rise from here, we think it's going to be harder to make money from those government markets. By contrast, in the corporate sector globally is in pretty good health. Revenues are stable or rising, debt levels are not rising, so the amount of cash flow that they have to support the debt is at very good levels. And we think the amount of yield that you get in the markets for that risk is very good. So we would look to the lower parts of investment grade, the triple B areas, plus the double Bs and Bs within the high yield area. And that's really across the world in terms of global credit markets.
Okay, let's talk now about the HSBC Global High Income. I've had a look at the return of this fund. I know that not the 3 years return, because the fund has not 3 years history yet, but the returns are really excellent compared to the other funds in its category. What is the secret of this fund? How would you present this fund to a particular investor?
Well, we have quite considerable resources globally that are involved in this fund. We have a research team of 35 dedicated credit analysts which are involved in looking at the issues that go into this fund. And we think that credit research is really the backbone of the fund. They're very good in their recommendations, and we would expect a lot of the benefit of owning the fund to come through from that credit research. Beyond that, there are various other things we can vary within the fund to try and add value versus the benchmark. But the other side of it is that this fund, the benchmark itself, is custom made for us by Barclays, and 60% of it is triple B, and most of the rest of it is double B, and we think this is the best part of the credit market. So going forward, we think that credit markets are going to be better than government bond markets, and we think that the triple Bs and the double Bs are the place to be, and this is exactly where this fund is positioned. So we would expect it to continue to perform well.
Yeah, and what about emerging market bonds?
We have those within the fund. They are 35% of the benchmark. At the moment, we're slightly underweight. We have been cautious on emerging markets, thinking that the valuations were a bit tight. A lot of money had chased the trade, and we were concerned about that, both in terms of the bond markets and the currencies. This recent sell-off has improved the value. So actually, we think emerging market debt markets are now better value than they have been, so we're looking to put a bit more money into those areas.
Okay, perfect, Marcus. Thank you very much for your views on the bond markets in general. Thank you very much.
Thank you.
Thank you.
Is run by investment bankers, and Morningstar's modus operandi.